to our panel on this. So we got what we expected, Francis. We got no cut. Okay, we got 2 dissents from Fed governors, first time since 1993, before you were born, even. Okay,
I wish.
This dissent happened. What is Jerome Powell going to do at the next few meetings? Because he's on his way out. And his legacy is, I don't want to say on the line, but what he does is kind of how we're going to remember him, because that's how things work.
I might take a step back and say there's so much focus right now on Chair Powell, the individual, as if we remove Chair Powell, that's suddenly going to change dramatically the path of the Federal Reserve ahead. I'm going to put forward that actually it's the data that's going to determine dramatically where the Federal Reserve
goes next. As Steve
goes
just said.
Next. Exactly. And the issue is for Chair Powell is we may not have full clarity, even by the end of Fed Chair Powell's term, on what exactly is happening with tariffs in this economy. I do not think we're going to be able to see by September how tariffs are infiltrating inflation. It's probably a late 2025 story. And at the end of the day, this is going to come down to, is it a demand destruction story? Is the U.S. going to slow down materially? Then you can have big rate cuts. Or is there a lot of inflation? And that is not related to who is Fed chair. That's related to the economy and trade policy.
Okay, Jim, I'm looking here at the CME Fed tool, Chicago Mercantile Exchange. You can see it on my computer here. David, you're just going to have to trust me on this one, all right? But it shows a 60% chance of a 1/4% rate cut at the September meeting and a 38% chance of a cut by the October meeting. Do you agree with that?
I think it's a fair assessment, right? So, but I think what we have to do is...
It's just the market's aggregating data.
It's the market's assessment, right? So the way I think about this is that we have been waiting for the impact of tariffs to hit the markets in terms of inflation, in terms of jobs, and we've been kicking the can down the road. We've got a couple of months to figure this thing out, and every month that goes by that you don't have higher inflation, that you don't have a worsening labor market, it creates a diminishing effect that the tariffs are going to be as negative as people think. Now, there could be a cliff effect, but I don't think it's a cliff effect where all of a sudden you wake up.
What's a cliff effect?
Meaning, like, all of a sudden you wake up one day and you realize, like, okay, inflation's suddenly arrived here. It's usually a progression. This progression towards higher inflation may be happening right now, but the rate of change is going to matter a lot. How quickly is inflation moving higher, and how quickly is the unemployment or the employment situation deteriorating?
Yeah, and I think the inflation numbers are going to get a good deal worse between now and the September meeting, because we've got two reports. What's happening is we haven't any historical experience of tariff increases of this magnitude. And by the way, by Friday, we think the aggregate average tariff rate is going to be close to 20%. So that's an enormous increase since the start of the year. What we know is the tariff revenue is coming in. So what that tells, and we know that import prices aren't changing. So that tells you it's not being paid by foreign producers. So it's either going to hit corporate profits in the U.S. or it's going to hit consumers. My bet is eventually most of it's going to hit consumers. And I think that's going to become clearer over the next few months, which makes it harder for the Fed to justify any rate cut in September.
So you're pretty squarely in the tariffs are going to be inflationary in some way camp.
Yeah, they will be inflationary. The problem is, and the thing that I think people aren't focusing on is, if you look at that big, the OBBBA, that has got a lot of fiscal stimulus stuck into the first half of next year because of income tax refunds. So you're going to get this big wave of sugar hitting the economy in the first half of next year. So if you get higher inflation at the end of this year because of tariffs, that could be sustained into early next year because of the reconciliation bill. So why do you want to cut rates now? I mean, we're supposed to be trying to get to 2%.
I don't know, but I'm sorry. I'm having a flashback to a couple years ago. We had this, something happened. We had this massive inflationary shock. We had a bunch of stimulus thrown at the problem. Yeah. I don't know if you remember that. A couple years ago, something happened. And now we're talking about this great potential inflationary shock. And maybe actual stimulus. Josh Hawley of Missouri was actually floating the idea of direct checks to the American people. How do we know what's going to happen with inflation, Francis?
Well, I think you've hit the nail on the head here, which is who
can afford nails?
We're so focused on what is monetary policy doing when the elephant in the room is that fiscal policy is dominating this economic cycle. It used to be, what is the Fed going to do was going to determine, are you early, mid, or late cycle? Now it's government money. And that pandemic stimulus that you're talking about, guess what? It's still in the system. The government is substantially larger than it has been historically, and it is keeping a floor under how weak the economy can get, but it's also creating underlying inflation. So I don't even need tariffs in order to be worried about the inflationary path and knowing it's going to stay above 2%. Tariffs or no tariffs, you're still having an inflation problem in the United States.
Let's look longer term. If there is a one-time price change, it's just a price shock, does that become inflationary? Or do we move into 2026 with business investment, accelerated depreciation, and potentially higher productivity? and let's look at wage inflation. I think we need to look at wage inflation to see if this inflation is going to stick around. If I look at the tips market, if I look at break-evens, things look relatively stable, somewhere around 2.4 to 2.5% inflation. That could be something that's in store for us, but it doesn't seem like the markets seem to be looking past this.
But also, in general, the other side of Washington is just piling sugar into the economy, and that means the Federal Reserve actually has to be a little bit more hawkish. If they have to be the tough ones, because it's, the deficit's going to go up next year. It was already 6% of GDP in a full employment economy, and we're going to push it up to 7. So if we're going to do,
but they were the def leopard of the economy a couple of years ago. They were pouring sugar on everybody. Well, they kept rates too low for too long, exactly. Stimulating, inflating the balance sheet, buying mortgages,
and Fed rate cuts, lower rates will push up asset prices, but they don't actually help the economy that much. We need stable inflation for that.